Okay, I think we'll be okay right now. So I'm going to get started. All right, hi everyone. My name is Seema Alexander, and I'm coming to you live once again, probably like the 5th time today, from the WeWork in downtown Washington, D.C. I'm the founder and chief strategy officer of Disruptive.ceo. It's a strategic advisory firm focused on supporting visionary founders and companies to scale and grow. I've had the honor and privilege of curating the growth track for the DC Startup Week community this year. We have over 16 panels and workshops specifically focused for the growth track, but 100+ panels and over 200 speakers for the whole week. So this is a really, really exciting time. You're new to DC Startup Week, this is the resource for you. We have different tracks for early stage, all the way to growth stage. So please do take a look at your Attendify schedule and make sure you do attend the ones that are most relevant to you. Before we began, I want to let you know that we could not do this without our partners and sponsors. We have several sponsors, but we want to acknowledge right now our title sponsors, Next, Insperity, Wiz, and Technology Rivers. As I mentioned, this is a complimentary free event, so without their large donations, we would not be able to do this and provide this for our community in the region. So in this session, we are so excited to have Stefan Nagey, her co-founder and CTO of Capbase, as our moderator for our panel on the ins and outs of angel investing. Obviously, this is a critical conversation for growth stage or growth focused entrepreneurs. Especially ones who are really looking to understand what it means for taking angel funding and all the ins and outs around it. So you guys are in for a real treat. Our panelists, we have Tien Wong, he's the CEO of Opus 8, as well as the founder and host of Connectpreneur. If you're not familiar with Connectpreneur, it's also a forum and has a community of over 8,000 CEOs, entrepreneurs, VCs, and angels. Tien is one of the most connected folks I know, so really good guy to have here. Melissa Bradley, she's of 1863 Ventures. 1863, the fund, has been created to provide access to an alternative financing model, revenue-based financing for the new majority entrepreneurs. You'll learn more in a few minutes about each of them as they introduce themselves. We have Anna Mason from Revolution. She's a partner of Rise of the Rest Seed Fund. And we have Juan Pablo Segura. He's the CEO of BabyScripts, and their company is revolutionizing virtual maternity care. We wanted to make sure we had a founder perspective when we talked about angel funding as well for you today. As a way of background, Stefan's company, Capbase, it's a digital backend for each startup, from incorporation, cap table management, stock issuance, corporate governance, and compliance, and all in one single platform. Just from a logistics perspective, we'd love to have your questions. They're going to have a whole time set aside a little later for that. If you do have questions, just put them in the chat. Just capitalize question and put your question after, and Stefan will make sure he tries to get to that as much as possible he can at the end. So with that, please join me in welcoming Stefan to the DC Startup Week stage. I'd let you take over from here. Stefan, can you hear us? Uh-oh, let's see. You gotta give us a second. Stefan, if we have to, we do have a phone number you can dial into. Give me 1 sec.
Yeah, I might have to.
We can hear you. Can you hear us?
You can, okay.
Yes.
Sorry, my computer, it seems, is unstable. So I'm trying to.
I think go ahead and get started.
Okay.
I'm going to send you the phone number just in case. okay?
Please do. Thank you. I'm so sorry. So yes, anyway, thank you for that lovely introduction. And thank you, of course, to our panelists and joining us today. We're going to be talking about angel investing, kind of what are some of the things that investors look for. But first, I wanted to give our panelists an opportunity to introduce themselves. And we're just going to go kind of in alphabetical order here by last name. So Melissa, if you'd like to lead us off and tell us a little bit about yourself.
Sure. My name is Melissa Bradley. I'm happy to be based here in DC and have spent a good portion of my adult life here. I am a professor at Georgetown, where I actually teach impact investing. I'm pleased that now part of the fund at 1863 Ventures, and like Juan Pablo, recently raised money via venture capital through a company called Ureeka. I've been an angel investor for probably over 15 years now. I finally just joined my first group. So happy to talk about the pros and cons of being part of a group, but really enjoy it. And as mentioned earlier, specifically invest in new majority entrepreneurs.
Great, thank you so much. Anna, can you tell us a little bit about your background and what you do?
Sure. Hi, everyone. Anna Mason here. I'm a partner with Revolution's Rise to the Rest seed fund. So we're headquartered here in DC. And we are the early stage arm, primarily seed investors, a little bit of pre-seed and a little bit of A, that sit under the Revolution brand. So we're led by our chairman and CEO, Steve Case, as the co-founder and CEO of AOL. I am a very proud DC transplant. I've been here for a little over 5 years now, and I've been at Revolution for about 4.5. I have 2 daughters who are 5th generation Washingtonians. So the other way to look at that is that we're never leaving. With that as the backdrop, it was really important to me from a life level and a professional level to work to connect with a firm and an organization and a team that, like my family, had deep roots in DC, and also like my family was hopefully not going anywhere anytime soon. I grew up professionally on Wall Street. I was a distressed and high yield bond and bank debt trader and a post-trade private equity trader, and actually kind of came of age in the street during the last Great Recession. And so I have definitely been spending a lot of time thinking about that lately. I have long said that one of the many reasons I've been drawn to venture capital is it has long seemed to me like the other side of the coin from distressed investing, big bets, binary outcomes. What I love the most about it is that we live in the bright side of the coin and really get to back entrepreneurs who are just optimists reimagining the future in a better way. And that's never felt more important than it has today. We're invested in more than 150 companies across 70 cities, all at the early stage. And we do quite a bit of co-investing with both other early stage institutional investors and also angel investors. In between my time on Wall Street and my time here, I had a stint as an entrepreneur as well, and raised money from a broad cross-section of investors, including many angels. So happy to chat about both perspectives as well. And great to see so many familiar faces and some new ones on this panel. So thanks everyone for tuning in here in DC.
Anna, that was wonderful. Thank you very much. Juan Pablo, can you give us a little bit about your background?
Definitely. Hey, everyone. My name is Juan Pablo Segura. I'm one of the founders of BabyScripts. We're actually based in Washington, D.C. Both founders are from the D.C. area, so very proud of our native D.C. roots. So our company, if you haven't heard of BabyScripts, we've essentially created a new way of managing pregnancy care through remote patient monitoring and digital technologies. We touch and remote monitor about 200,000 women a year in 27 different states in more than 60 health systems. I know we're going to be talking about funding and how best to leverage angel networks. We've raised a little over $18 million in both angel and venture so far. And, you know, we're really kind of at the nexus of trying to figure out how to solve a lot of the maternal mortality and morbidity issues that we have in this country. So, you know, just again, really excited to share the entrepreneur's perspective. I unfortunately don't We haven't exited BabyScripts. I don't know when we'll exit or if, we're going to drive this to an IPO, of course, but I do hope to become an angel investor at some point, but I can definitely represent, some of the ins and outs of kind of the entrepreneurship or the entrepreneur's perspective. So excited to be here.
Thank you, Juan Pablo. Tien, can you tell us about your background, please?
Yeah, absolutely. Thanks for having me. I'm Tien Wong, CEO of Opus 8. Opus 8 is a consulting company that helps tech companies and alternative investment funds raise money, mostly through our network of high net worth individuals and international institutions. I'm also an angel investor. I've invested in over 2 dozen different types of companies. I started as an entrepreneur. I built a CRM company and was lucky to exit to a public company back in 2003 and became a full-time investor. Along the way, we acquired a couple of small companies. One is a government contracting, cloud computing, cloud services platform, and the other one is an ed tech company based in Erie, Pennsylvania. As Seema mentioned, we started Connectpreneur a little over 8 years ago. This is our 9th year. We've done 50 events and have had over 20,000 attendees. Shameless plug, our next event is September 30th. We'll have some awesome presenting companies and hopefully you guys can join. Anna and Melissa have been panelists in the past. Thank you guys very much. And we are using our Connectpreneur platform as well to source deals and to invest on a one-off basis and also to create a new fund called the Phoenix Fund, which will be investing in fintech, health tech, and marketing tech / CRM opportunities, and we're reserving half of our capital for underserved founding teams. Thanks for having me.
Great. Thank you so much. So as Seema mentioned, I'm Stefan Nagey. I'll be your moderator today. I'm co-founder of Capbase.com, where startups start up. And for the folks in the audience today, if you have any questions for us, please just type them into the chat. Type question in all caps if you don't mind, so that I'm sure to see it. And just to give you a brief overview of the format today, we're going to have a series of prepared questions that we're going to ask our panelists to weigh in on, and then we're going to take questions from the audience. So, getting started, kind of one of the things that as an entrepreneur you're always looking at when you're approaching angels is, who are they looking for? So if you guys could go into what is your investment thesis? What's important to you when you are looking to do an investment? Is it the company, the idea, the team, the traction? Just what's important to you? What are you looking for? And then, as an entrepreneur, Juan Pablo, if you can give us your perspective on sort of how you evaluate these things. So
I'm happy to kick us off.
Great.
So I know everyone's either been on a lot of panels, attended a lot of panels, and I think folks oftentimes will come back to a lot of these same topics. Team is so important. Market size is so important. I think taking a step back, and this has been particularly poignant for me in this virtual only Zoom land age where we're all engaging in 2-dimension with each other. I think some signals and flags for us are what has the founders or founding team's experience been in the industry. We found with a lot of the the companies and very early stage companies that we've invested in, we have an interesting thread line and subset of companies where one of the founders was born out of the legacy industry or the analog industry that they're looking to disrupt. And I found, as I think about the cross section of our portfolio, some who have really had, rocket ship style growth across a broad cross section of industries. I found that there's a really strong marriage and partnership in the co-founding team, where one of the founders has deep domain expertise in the legacy industry, and the other typically has, depending on whether or not it's consumer or enterprise, has a pretty strong either marketing or sales muscle that she or he has been able to flex pretty impactfully. And so I think for me, partnership is actually a pretty important signal and marker that we're often thinking about. We do invest in solopreneurs. I perhaps have a bit of a preference to invest in a co-founding team because it's a long slog. It can be a little bit of a lonely slog, and thinking about how those partners and how those co-founders support one another is pretty important. But behind the scenes, I do also look to actually see how the founders interact with one another. And so we've been very comfortable. We've long been comfortable investing in companies without necessarily meeting the founders or the team in person. It's a model we're comfortable with. We've tried over the past 6 to 9 months, well, we have been pretty active through, investing through 2020 to spend more time in different types of meeting settings with more members of the team than maybe just the CEO who's presenting. And we found that to be pretty impactful.
Great.
Oh, sorry.
Oh, sorry, please, Melissa, go ahead.
I was going to say, I think a lot of this depends on what stage you're at, right? I mean, my desire to be an angel investor was born out of the fact that when I started my very first company, I couldn't raise any money. No one would give me any money. I had an investor tell me no because I was Black, I was a female, and I was in financial services, and she had no proxies or precedent for me. And so that certainly shaped the rest of my entrepreneurial trajectory, but certainly informs my investing thesis because the company went on to have an exit. But it is that, I'm willing to risk it because I didn't have it before. So this is a chance to really be catalytic in the lives of entrepreneurs who otherwise would be overlooked and underserved. I come with the expectation that you will leverage both my check and my expertise, and I need to come with some social capital and connections. I have historically tended to be the first check, so there oftentimes isn't a team, but I certainly am pretty rigorous in wanting to see a plan. I make sure the entrepreneur understands the difference between building a growth company and a revenue company and really trying to figure out where they are in that process. I think a lot of times, particularly because of all these shows and, we have defined investment as a benchmark for success, it's really important to understand what's the trajectory of the entrepreneur. So I may spend an inordinate amount of time in my pre-due diligence and due diligence process because a lot of that is also educational. A lot of them don't have founders agreements. A lot of them don't have a board of directors. They haven't thought about equity pools as they enter into this space. And so I look at it as if I don't write them a check, have I been able to help them and advance them? And then if I've given them advice and they've utilized it or not, but have shifted that trajectory or made a pivot of any sort, then I know at least they're open to feedback because as an early stage angel investor, anything can happen, right? And I think you want to know that you're investing in a business you understand. You're investing in an entrepreneur that you believe is coachable and that you can be in partnership with, and that you're investing in someone, I'd say lastly, that is pretty transparent. So I look a lot for processes. Know that all of our goals are collectively toward scale. Do you have some kind of CEO dashboard? Do you have some kind of status reports that you're just using now that I can be a part of to really understand the trajectory of the company? Because ultimately I'm going to be looked at to pick up the phone, open the door, and help them move on. And I want to make sure that I can do that with solid footing, that I have done my research, that I believe in them to no end, and that I am willing probably to continue on that journey, because I'm certainly finding that more and more angels are being asked to stay in a lot longer. And so therefore, I think that's also shifted the dynamics of some angel investors in terms of when they come in and how much of a role they play in subsequent rounds.
Yeah.
Wonderful. Thank you. Tien, can you give us your perspective, please?
Yeah, sure. Absolutely. Adding to what Anna and Melissa have to say, I think when you look at the whole totality of an opportunity as an investor, the idea gets, I think, overvalued. In our opinion, the idea is really not worth that much, maybe 10%. Execution is probably worth 90%. I'm probably exaggerating a little bit, but we're trying to assess the execution risk and the execution capability of either the entrepreneur or the entrepreneur's team. So that's hard to do, but we look for some of the soft skills. We're looking for coachability. We're looking for communicativeness. What Melissa mentioned about transparency is very important to us. We want entrepreneurs who understand the importance that when they take money, that this is no longer a lifestyle business. This is real business, and you have to report into your stakeholders in a formal manner. The coachability factor is less for us to coach them, but more that they are open to ideas. We found that a lot of entrepreneurs that are fixed in their ideas and not open tend to be very challenged when it comes to pivoting, and every early stage company is going to have to pivot many times. So if somebody has an open mentality, that we think that de-risks the investment for us. Finally, we look for entrepreneurs who are super resilient, whether they've overcome things because they were a minority or an immigrant or a child of an immigrant, or adversity in athletics or an injury or whatever, and to see what they have become as a result of these overcoming these challenges, because I think that is a good proxy for how they're going to react when they have challenges in business. And as you entrepreneurs all know, there's multiple challenges every day. So a lot of success in entrepreneurship has to do with being able to absorb the blows and to basically get up every morning with renewed passion after getting punched in the face a few times, and do that every single day for many, many years. So we look for that kind of resilience.
Yeah,
That's one.
and just from the entrepreneur perspective, number one, I think we get punched in the face every day. It's not just a few times, throughout the journey. So it's definitely a challenge. But I mean, the way I've always looked at interacting with investors is it's never, at least early on. When you get later on, Series A, Series B, things become a lot more financially driven. But earlier on, it's more about the story that you tell. And so, and as you tell that story, you as the entrepreneur, really, you're in the driver's seat. How do you communicate traction, for example? Very early on, sometimes it's hard to generate revenue. But when we started BabyScripts, a lot of our milestones weren't necessarily, we reached 1 million ARR. It was more, hey, we got this pilot started. We got this partner signed. We joined this accelerator. And so I think number one is you as an entrepreneur really have to think about how are you communicating traction to create momentum for investors, because investors are motivated by something called FOMO, right? So if they feel like they're going to miss out on an incredible company, an incredible opportunity, that gets them moving more than whatever spreadsheet you can calculate on Excel. And so I think that's kind of one piece of the story. And everyone here has likened or has talked about some of the soft skills and the personalities. People, at least my interactions, and they've told me explicitly on the angel side, one investor says he likens it to a horse race. He goes, I don't bet on the horse, I bet on the jockey. And so really, angel investors are betting on you, the entrepreneur. And so how likable are you? All these things, how professional do you seem? Some of them seem very trivial in a lot of circles and in a lot of spaces, but you're creating a very personal relationship with an angel. I mean, angels are people that are wealthy individuals who've made a lot of money in finance or in real estate. At least in DC, there's a lot of people that have made a lot of money in real estate. And so they're looking to a different style of investing, a different relationship. They kind of want to see you succeed. And so for the soft skills and how you build relationships, they're just as important as the narrative or the market opportunity. I mean, I came from outside of healthcare and have started a company that's transforming healthcare. So I actually didn't have any relevant experience when we started the company. But again, we built relationships and we focused on obviously growing with our investors every step of the way.
That's wonderful. Thank you, panelists, so much. So moving on, kind of our next question, we've talked about sort of what we look for when we're doing a deal. But how do you source your deals? What do you do to generate deal flow? And how should founders approach you? And also then from the founder perspective, how do you approach angels that you don't know, or how do you increase your pool of people you talk to?
So I'll start. I mean, I people have been asking me for my email in chat, so I'm happy to share my email. People reach out pretty regularly. Back in the day when we were in person, I would stand online. I made a commitment to myself a long time ago. I would talk to anybody and everybody who wanted to talk to me within reason, as long as like we didn't get shut down or locked in. Because I know how hard it is, particularly for entrepreneurs of color, to kind of get the inside scoop and have somebody give them advice without it being used against them or for them if it's positive when they're raising money, because those are two different conversations of kind of informational versus investment. But I just joined an angel group. I actually joined two. So it's been interesting to now have more deal flow coming my way, but I'm pretty easy to find. And so I tend to get, as a professor at Georgetown, I tend to get a lot of students who are current or past or alumni who are starting businesses reach out and we respond. We obviously, running the accelerator, get tons of people who reach out. I'm part of several organizations where on any given day, the database has over 10,000 entrepreneurs of color, since that's who I invest in. And then, I keep doing events like these. And what I found with the angel group, I was very, I'll be honest, suspect at first, because oftentimes they wouldn't find the deals. But I think in light of COVID, in light of post-George Floyd, I'm seeing more and more investors reach out because there's now a wider aperture in terms of what diversity means. And there's also a recognition of the historical and current hurdles that many entrepreneurs of color face, but it doesn't mean that they're not as good and don't have the same potential trajectory. It just may take them a little longer because we tend to raise less money. I would say, be mindful that if you can find individuals to talk to first before you go to a group or for a firm, please do. I just sent that in the chat to someone because I think the risk tolerance and opportunity cost of going into a group without having someone who understands the space and getting their feedback is not useful. And oftentimes you only get one shot. And I think that there are indeed some nuances and some expectations that I have learned now being part of a group that they use as kind of gating triggers, which I think are good ones, no bias, nothing, they're just good things. But I think oftentimes there's a disconnect between what investors are looking for and what many of these accelerators and incubators are providing. So the more you can get in front of real people, then the better off you are. And luckily there's tons of angel groups now that have open sessions, no judgment zones as they call them. So I would say, don't just focus on trying to contact the person that you want to invest in, but find some individuals who are investors who are willing to share what the process is like on the other side, that you can be well prepared.
No, that's great. And kind of just jumping onto the idea of accelerators. So I'm a huge fan of participating in as many accelerators as you can in the early stage. I mean, at BabyScripts, we've gone through 5 different accelerators before we got to our Series A. And so I think for most founders out there, every industry has like dozens of accelerators. In healthcare, there are so many for you to take advantage of, and most of them actually don't require you to give equity away. So I would really look at a panoply of options. Most health systems, even health insurance companies, have some kind of early stage outreach program, and that actually really fueled our early kind of angel investing growth and opportunities. I mean, Melissa, you just said it. Like, you're looking for leads, you're looking for contacts and good entrepreneurs to invest in, and these accelerators act as kind of gatehouses to the like really reputable and active investors out there. The only other thing I would say is, don't get disadvantaged as you fellow entrepreneurs are out there pitching. The whole process of raising capital, this is a tautology. I defined it by saying it is a process, right? Like, you're going to have to go out, you're going to have to pitch dozens, if not hundreds of people for a specific round. We pitched 121 funds for our Series A, just to give you an idea. And every subsequent round gets a lot easier. So don't think that it will always be that way. Like, we're in the process of raising our Series B right now, and it's a lot easier right now because of traction and growth and all the things you develop. But at times it's a numbers game. And, we actually pitched our Series A investor 3 years before we raised our Series A from that investor. They turned us down initially, but we kept them informed. And so I think a forgotten tactic in the startup space is you have to both make a connection, develop a relationship, and sustain that relationship over time. Send email blasts with updates. LinkedIn is an incredible tool to share traction, cool things, great things that are happening with your company. And lastly, really look at soft or warm introductions. A warm introduction is the best way to get a pitch scheduled and a way to kind of build a relationship with someone. A cold call, it's tough. And I know these guys on the panel get hundreds, if not thousands of cold call outreaches a year. So, definitely look at ways where you can build on personal relationships to get to the right person to pitch.
So the plus one to the comments that have preceded mine, I would add and offer the perspective that I think it's most helpful to think about fundraising like customer acquisition. And you want to put your sales hat on or your marketing hat on, which we know founders spend, you typically spend the vast majority of your time either building your product or thinking about how you're going to sell your product and reach customers. And in many ways, literally and figuratively, your fundraising process is the other side of that coin. You are in fact selling something. You're selling a percentage of ownership and equity in your company. And so you can apply many of the same principles that you would when you're out there kind of hammering the other side of that nail. And what I mean by that is that, think about all the steps and all the effort you might take to get 100 people to hit your website so they learn about you. Then think about some of the tactics you might put out there to just build your brand and build brand awareness so that you start that word of mouth flywheel. Oh, did you hear about, hey, I discovered XYZ. There's, at the end of the day, investors are just people too, right? And so thinking about how you can know your customer and know the investors that you're targeting, think about the customer persona that you might build when you're building out your marketing plan or your sales plan for your product. It's very much so the same thing when you're thinking about investors. Am I ready for angel investment? Am I going for institutional investment? What does that mean? What is this fund or this group focused on? How can I connect with them in different ways? How can I have this story resonate with them? And everyone's got a short-ish attention span. What's my hook? What's my Twitter pitch? How am I really going to capture them? Am I actually explaining what this is and what this does? Like, would this investor buy this product in some way? And so I think just I found that there's a lot of great work that's out there in terms of democratizing access to how funds work, how angel investing in those groups work, but there's still a little bit of this like demystification, I think, that's underway on that side of the process, whereas there's just a tremendous amount of a wealth of information that's out there. And I think it's perhaps a little bit more of there's like a little bit more straight line thinking in terms of how you're going to reach customers. So if you just have a little bit of a mindset shift and start to apply some of those same principles, I think there's a ton that you will find flows naturally from that. And the final piece that I would add that relates to this idea of thinking about investors as customers and that same funnel is how can you build third-party validation for yourself, for your business, for your product? It's while Juan Pablo, I agree to a certain extent in principle on the warm intro dynamic. I think there's also a tremendous amount that's increasingly out there about what it means to get a warm intro, how it's not zero sum for all founders across the board. And so this is actually one reason why I love accelerators, why I love pitch competitions, why I love grant applications. Like, you don't necessarily, as a founder, always need to go straight to, I need to fundraise, but how can you validate what you're doing and have an investor group build trust in you? Because that's ultimately what this is. It's a question of trust and belief. So acquiring customers, great way to build trust. Winning that pitch competition, great way to build trust. Getting accepted into an accelerator program, great way to build trust. Or perhaps just developing a mentorship or a championship relationship with someone else who's a trusted voice and source in the community. So all of that just comes back to third-party validators for you as a founder or for your company as a business.
Yeah, I'll just, and I think,
Oh, sorry.
go Tien. The only thing I was going to say is, I think trust is such an important word that is underemphasized in this space, because I always reflect, I sometimes get very meta with the whole startup process. But when you think about like the process of winning over an angel's $25,000 or $50,000 in investment, I mean, you're taking someone's money that they've worked so hard to earn, and they're betting it on a concept or on a group of founders, and they inherently know that the likelihood that that investment works out is close to zero. And so that whole process of building trust, that is so crucial for an entrepreneur and investor combination. And if you don't think that, you know, no one just freely gives their money away. I mean, think of just how you spend $100, right? So I think that process is crucial for anyone looking to raise capital.
Yeah, I was just going to say that Anna's 100% correct. This is a sales BD customer acquisition exercise. And from the investor standpoint, it's the reverse of that. So where you may have to have 150 angel meetings to get 2 investors, the investor is looking at 100 meetings to find 2 awesome deals to invest in. So what does that mean for you as an entrepreneur raising money? That means you need to do your homework, deep homework for each and every meeting. So don't just go to a meeting and wing it. Make sure you understand who you're meeting with, their full background, their portfolio, what kind of deals they're doing, how many deals a year they're doing, check sizes, and all of that stuff. I don't think angels invest stupidly. These are mostly smart entrepreneurs or people that have made a lot of money, and they're pretty judicious and intelligent about how they invest their capital. Yes, they may take a liking to you. That helps a lot, but for the most part, this is a business transaction, and they're, don't take this in the wrong way, but they're greedy investors. They want to make money on the money they give you because they have alternatives. So just keep in mind though that, you know, every meeting you have, there's a very good chance it'll be a no, and just be persistent. So, you know, I mean, Anna probably looks at hundreds of deals to make one investment. So, you know, we don't have that kind of ratio. We might have 30 or 40 deals to make one investment, but still just know that the odds are against you, and it's sort of the inverse of customer acquisition.
That's all wonderful. Thank you. And so, you know, kind of talking from, you know, we've first talked about like kind of, well, what's important, you know, how do we then find those deals? But then, you know, kind of getting into the nuts and bolts of this, you know, discussion on ins and outs. What do deals look like for you all? You priced round, unpriced round? What kind of diligence do you do? How can founders be prepared? Do you guys do safes, convertible notes, KISS, you know, kind of for some of those unpriced options? What, you know, kind of, and then to what degree do those mechanics matter, or is that more something that you look for the founding team to lead on?
I would say that this is, a lot of it depends on the entrepreneur and the field, right? I know what I know, and I'm pretty clear what I don't know. But I've taken the position that I don't have to be an expert in that field, since so many new things have come on, particularly some of the tech focused stuff, that if there is a stronger lead, I'm still willing to support. Because I still am investing with the thesis of, if I can be that first or second check for an entrepreneur of color, it'd make all the difference in the world. Knowing that it costs $250,000 more for a Black entrepreneur to start the same business as their white peers, my goal is to fill that gap. So my range is anywhere between 0 to 250. I prefer convertible. I cannot wrap my head around these safes, but if that's what the lead is doing, then I'm willing to follow them. Even if somebody else leads, I do my own diligence. So I need at least a month to 2 months to be able to have some conversations. I will do diligence just because I'm a finance person, probably more like a VC. So I will take your financials as an Excel sheet and rip them apart and do all kinds of scenario. Because again, I think the best thing I can give you is honest feedback. The next best thing is I can do is to write you a check. So I tell people to be timely. Don't need the money yesterday. When you come to me, at least need it maybe by next week, so to speak. And then again, my preference is investing in entrepreneurs of color, but at least if there's a diverse team, I want to really be able to fill the gap where other people are not going to be.
So we're an institutional seed stage investor who does not lead rounds. So we like to call what we do, or try to call what we do, catalytic co-investment capital. And so what that means to us is that we try really hard to be a flexible and friendly investor. We'll invest in safes, we'll invest in convertible notes, we'll invest in priced rounds. We will not invest in common equity, but we will, of course, invest in preferred equity. In terms of what we're seeing out there in the market, so one thing, one aspect of this and this goes back a little bit to my know your customer comment from earlier that I think is helpful for any founder who's looking to raise money to think about is to do the best you can to try to best understand what the strategy is of either the angel group, the individual angel, or the investment firm that you're talking to. Because within venture and investment funds specifically, this is a little bit off topic from angels specifically, but we actually have a business model that we think about too, right? Like venture is a business, we hope. And so we have to think about portfolio construction. And so what that can mean sometimes, for example, is love this deal, love this founder, think it's a brilliant business, actually think it's going to be a massive, massive opportunity, given the deal dynamics, whether that be how much is left that's available in the round for us to invest, or the pricing and the dynamics of where the round is pricing, or perhaps even capping. We actually have come to the really difficult decision that does make sense for a fund. And that's a cost of capital issue for us and a little bit of a time value issue for a fund as well. And so part of what we're thinking about, and just to share a little bit more about our strategy for context, because it took us a minute to get here too, we're now early investing out of our second fund, is that we'll typically invest either into a convertible note or safe or priced equity round that either the notes cap or the round prices between $5 and $15 million pre-money. And we're typically putting either $250,000 or $500,000 into that deal. And the deal is usually $1.5 to $4 million. So you can kind of do the math there and figure out what our average ownership percentage is on the way in. And you can tell that we're not one of those funds who's trying to get 10 or 20% out of the gate. But the reason why we care about valuation up front is because we reserve half of our funds. We have $250 million funds. We reserve half of each fund for follow-on investments. And when we do those follow-on investments, we don't want to be writing another 250 to 500. We want to be writing $1, $2, $3, maybe even $5 million in follow-on capital. And that's part of the model that's evolved for us. So we care about price in that context. And that's just, it's one anecdotal example to try to underscore the broader point, which is sometimes it's us and not you. And the flip side of that is to ask yourself as you're going through this fundraising process, if angel investment or institutional venture capital, if like venture style investment is the type of money that you want to take for your business. It's a really long-term relationship. Everyone's money is probably going to get locked up for a while. And it typically, though this is changing in some really interesting and exciting ways, it typically tries to dictate and push a company into a very specific direction and pattern of raising more money over time, not less. So it's if you're thinking like you have a one and done fundraise, you might not want to get angel capital if you can maybe think about a small business loan or some other types of funding. So that's the perspective I think I would offer up on that front.
We've rarely invested in common. We have done common deals. We've done some preferred stock investments as well for the companies that we don't have control in. But for the most part, we prefer convertible debentures or convertible notes. Primarily, we have invested in safes. We almost always follow on. So our check sizes are between 100 and 250 roughly. We've gone bigger in some deals, but we would prefer to kind of tag along somebody else who's leading and setting terms and who's done a lot of the diligence. We do, as Melissa said, we also try to do as much diligence as we can. We try to invest in sectors that we know something about, where we actually have customer relationships as well as individual relationships, where we can help diligence the team and diligence the technology and diligence the markets, et cetera. So it really does vary, but safe notes are a new, or safe warrants, I guess they are, really technically speaking. That's a new structure here on the East Coast. It came out of the West Coast with YC. It's something that I'm not 100% comfortable with, but certainly if the lead investor is going to do a safe, we will do it. I'll make a comment about valuation caps. Some entrepreneurs, I think, get hung up on valuation. They want the maximum valuation at the seed level and pre-A and A. And unfortunately, I've been a shareholder in a couple situations where that came back to bite us later with respect to down round and getting a lot less than we could have. And I think get really good counsel and really understand what you're doing when you're raising money, because it's not always about the valuation cap. It's about the terms of the money and how the waterfall works upon exit that you really have to look at. So I think there's of course, everybody wants the highest valuation, pre-money value possible, but if it's ridiculously high or out of the market high, believe me, these professional institutional investors will get their fair share, because that's what they do for a living.
Yeah, and I would just add a couple things. Number one, or first thing, kind of category wise, is just tips and tricks. I mean, number one, I'll take any kind of, or I'll use any kind of instrument to raise capital as long as I can raise it. So that's typically the early stage mentality, and I don't think we can be too picky, especially in the early stage. To Tien's point, you really have to know, if you go the venture route, and I think that I've counseled some younger entrepreneurs and really kind of figuring out whether they need external funding right now, or if they can wait a little bit and kind of get through a little more bootstrapping, because the venture style growth, it has a lot of requirements, and Tien mentioned it, like there's a whole step up process and expectation. When you raise $1 million, you've got to grow the company by X amount by X time period, and you've got to raise 5 million more at 2 or 3 times the last round's value. And as you kind of progress along that journey on the venture side, things get a lot harder. They get a lot more financial, and there are vultures ready to swoop in and essentially force a down round if you're not hitting specific financial metrics. So really understand the venture capital process. I will say though that from the entrepreneur side, you have options and you have to iterate, you have to be creative. And I think everyone alluded to this in a different way, which is this whole concept of lead investors and follow-on or syndicate partners. And as an entrepreneur, most people here, if you guys are trying to raise capital, you'll know that the hardest thing in the world to do when you're trying to raise a round is find the lead investor. And so, because no one wants to be the first, and everyone's okay being the last if all the money's already lined up and ready to go. So, in trying to find that lead investor, because investors do like to move together, you don't subscribe to the prototypical process where you have to find a lead investor and everyone has to jump on at the same time. We actually were really creative in some of our angel rounds where we did what's called a rolling close, where we just let people invest whenever they could, whenever we found someone interested. And so instead of finding someone that would put up half the round amount early on or from the get-go, we kind of took in, it was $1 million round. We took in $25,000 at a time. We got it close to $600,000. And then all of a sudden people said, oh, the majority of the round's already been raised. I'm more comfortable participating in this deal. And we did it basically without a lead investor. So, you have options. Just use your network to really understand the best process for trying to get that round closed. Because at the end of the day, what you need to do is close the round and continue focusing on growth.
Thank you, panelists. So just kind of keeping an eye on the clock, and we've got about 10 minutes left. I wanted to take an audience question. And, I think it's very timely to how we're all convening here today. The question is how has the current situation with COVID affected your investments? Are you investing as much, more, less, differently? What does the landscape look like today that it doesn't look like that was different from a year ago? And how can people best be prepared to capitalize on that?
I'll take this one to start. I want to break my comments down in a few different ways. First is the overall timing of the market, and I think where we are in the cycle of 2020. So if we'd been having this conversation 6 months ago, I would have said, very difficult time to go out with a new fundraise. And that was really largely driven by the market dynamics of existing investors really just largely all turning to our existing portfolio companies and assessing where they are in terms of the storm and what that risk or opportunity and what that risk profile looks like. Really getting a lot more tactical and granular on cash management in a way, by the way, that I think will be very positive for our industry over the long term. But there was a lot of offense and a lot of defense that was going on with all kinds of investors and founders and portfolios all across the country. But I think that started to really free up quite a bit. And so, we have been investing actively during this cycle and everything going on in the pandemic. And we are seeing a large number of co-investors do the same. So I think the headline is, it of course depends on the industry that you're in. I do continue to think it would be a little bit difficult, for example, to raise for a travel and hospitality business right now, though I read some really interesting stats on that the other day that's starting to really open up too. So from the institutional investor set, I think now's as good a time as any to try to go out and to fundraise. I'm curious to get the perspective of others, but I think it's a little bit more nuanced with the angel community. When you think about where angels are getting their capital from, right? So on the institutional fund side, we were fortunate to have closed our second fund at the end of 2019. That positioned us to be well capitalized with dry powder to go out and make these new investments. Funds have to fundraise just like in startups do. I know many funds, unfortunately, who've got a little bit caught in the crosshairs of what's going on, and their fundraises have been slower. So if you're not taking in LP money, you can't put it out to invest in startups. With angels, it's hard to know what people's individual circumstances are, and there's just been such large scale dislocation across so many different industries, so many different types of businesses. In particular on the real estate side, where a lot of folks who've made money in traditional businesses like real estate look to then diversify into more esoteric asset classes like venture and startups. So I think it's far from one size fits all on the angel front. And in terms of what we're seeing at the very earliest stages more broadly, what I've actually been hearing from a number of investors who invest a little bit later stage, Series A, sometimes even Series B, is that they're getting comfortable investing earlier in this environment. So they're saying, okay, we can wrap our heads around investing remotely in a team without necessarily meeting them in person, but we're not sure if we're going to write that $5 million Series A check. Let's take this opportunity to go a little bit earlier and let's write a $500,000 or $1 million seed check. So I actually think there's more net capital coming into the very early stages because it's kind of falling down the waterfall. Whether or not it makes sense to take money from an investor that typically invests later stage and is opportunistically playing earlier is a longer conversation for another day. But I think the broader headline is, at least with early stage institutional capital, seeing some nice positive trends about being able to raise money right now.
I would say, like in 5 minutes, I have a due diligence call. Like, I think the market has accelerated from an angel perspective. I would also say I'm in a unique position because there has been a massive acceleration. We'll see if it converts to investment of interest in entrepreneurs of color. So like my phone does not stop ringing for good and bad reasons. And so I find myself on lots of calls lately in the evening, both talking to entrepreneurs and participating in various due diligence processes, the 2 angel groups that I have joined. You know, I think angels, honestly, like from a business perspective, now is as good a time as any because valuations are changing and it's an opportunity for us to get in early and possibly stay a little longer before we get kicked out by the VCs. I'd say, you know, pricing has changed. So, you know, you should really examine whatever your expected capitalization is in light of the fact that we have no idea when we're coming out of this. You know, I certainly have also seen an increase in healthcare and healthcare tech or anything that's in that space from lots of angel groups. But I think to Anna's point, not a lot of the angel groups have changed because the expertise is driven by the composition of the group, and that hasn't changed. If anything, I have seen in both groups I've joined probably a 20 to 25% uptick in angel investors because there is this movement of people who are able to do it and have the means try to get more involved as the markets are erratic and for whatever their own social and personal reasons are. So I would say there is an active investment community. There's a lot of new institutional funds that have finally come down to pre-seed, although that was a relative definition. I think if you asked all of us what pre-seed was, you'd probably get 4 different definitions. But you have a lot more funds out there that didn't exist before. Particularly some of the banks doing funds. I think if Volcker gets changed, you're going to have a lot more banks and investment banks doing funds. So I think to Anna's point, well, this time of year, you usually have a very short window because we operate on the seasonal cycle in some respects and just managing our portfolio. You have a lot more people who are beginning to move into the space. We're fortunate that none of our companies struggled post-COVID, but I think that's just part of the discipline that has been instilled through the accelerator around cash management and investing in yourself and, you know, making those kind of systems and process decisions. So I would also just want to really highlight Juan Pablo's suggestion around getting in a program. You know, I think that this is a time of such great change that I think entrepreneurs can benefit from just different perspectives. And there also may be some dilutive or non-dilutive capital on the other side, but I think this is such a unique moment that the more advice and feedback you can get from folks who understand where you are, the better off you are as you begin this investment process.
Thank you so much, Melissa. So, you know, I wanted to really thank all of our panelists here for providing such wonderful insights today. We are unfortunately at the time where we're going to need to wrap up, but what I would love to encourage everyone to do is to visit the event page on Attendly to where this session was, and any follow-up questions you had there, you know, please just post them. And myself and the other panelists, you know, we'll be kind of checking on that and trying to answer questions. And I am sure that all of these panelists today would be tickled to have you reach out to them on LinkedIn or on the Attendly platform or anywhere else. But again, thank you all so much for attending, and panelists, thank you so much for taking time out of your busy days and your busy schedules to join us in this conversation.
Thank you so much, Stefan, Anna, Juan, Tien, Melissa. We really appreciate having you here and sharing your insights and experience with everyone within the community. Thank you for everyone for attending. Quick things, feel free to introduce yourself or share any insights onto the activity stream in Attendify. We have a couple events coming on next. We have a founder chat with Neil Gupta following from 5 to 5:30, which is then followed by our pitch competition, where we're doing it a little bit differently this year, where it's going to be fully virtual. 10 startups will be pitching. It's going to be a pitch battle, and the judges are going to pick the top 5 who are going to be in the closing pitch competition on Friday at 2 p.m. So again, thank you so much for the wonderful panelists talking about the ins and outs of angel investing today. And we hope you join us for the next fireside chat going on at 5 p.m. And that link is within Attendify. Thank you, everyone.
Thank you.
Thanks.